Louis, thank you very much for joining us today. How are things in Hong Kong?
Thank you very much for having me. Things are in Hong Kong are better than they were 3 weeks ago. The markets have obviously been ripping. If you'd asked me the question 3 weeks ago, I would have said things are quite morose. It's been sober years for Hong Kong. Hong Kong is a town that lives really off its financial sector, and dearth of IPOs. The rest of the world deciding that China was uninvestable, so all the asset managers seeing big redemptions, and the private bank guys suffering as well, as a lot of rich Chinese people felt that maybe Hong Kong wasn't far enough from China and they wanted to move their accounts to Singapore. So you add it all up, it's been some sobering years, but past 3 weeks, 2.5 weeks, obviously markets have been ripping higher. So everybody's got a little bit more of a spring in their step today. Starting to feel a little bit better. But let's not beat around the bush. It's been a rough 5 years, let's put it this way.
Well, this is one of the reasons why I wanted to speak to you today to get your knowledge of the area. And here we are, we're in the last quarter of the year. It looks like it's going to be a very interesting next few months. We have increasing hostilities in the Middle East. We've had these major policy changes out of China. We still have two more Fed meetings before year end. And of course, we have the US election. And I want to start with the big picture and get your views on the global economy. And I just want to focus on the two largest economies, the US and China. And why don't we tackle the US first? The economy is growing at 2 to 3%. Inflation is slowly coming down toward that 2% target rate of the Fed. Unemployment is ticking up, though. It's 4.2 to 4.3%, but still well below the long term average. What's your view on the US economy, and do you have any concerns?
So look, I think you have an economy. If you're going to have a concern, it has to be on the fiscal side of things, where you've got an economy, as you pointed out, that's roughly full employment, an economy that's been growing at roughly 6% nominal, and with that, you have budget deficits of 6, 7% of GDP. Now, when the government spends that much money, it's pretty hard to get into a recession. There's just so much fiscal stimulus that the economy just keeps chugging along. Um, but of course, you could wonder, okay, at some point, having budget deficits, having 125% debt to GDP, and having a government that spends roughly 40% more than it takes in, is a little bit like going to a party and doing tequila shots. You never know when you've had enough until you've had too much. And this is the problem with government debt: is it feels good, it feels good, it feels good, and then bang, you hit a wall, and then it doesn't feel good at all. So if you want to be concerned, that to me, that would be it. Now, historically speaking, a government that spends 40% more than it takes in, how does this manifest itself? Usually it manifests itself through a higher inflation. Now, you said that inflation was getting back to the 2%. Um, I think we've had every reason for inflation to roll over in the past 12 months. First, of course, the easier year-on-year comparisons. Secondly, falling energy prices, falling soft commodity prices, China being a huge deflationary weight on the world, the yen going from 130 to 160, that was just crazy undervalued, renminbi also being weak. And with all that, we still didn't manage to hit the Fed's 2% target. We're still at 2.5 today, and so you look at this, and the Fed basically came out and said, you know what, guys, close enough. We don't need to be at 2%. We're broadly in the ballpark. Let's put some more fuel on this fire and let's get going. So where do we stand today? Well, you've got a Fed that's easing monetary policy, a US government that's following, frankly, crazy easy fiscal policy given where we are in the cycle. And you know that after the election, regardless of who wins between Donald Trump and Kamala Harris, uh, whoever wins, the next president will do another round of fiscal stimulus, because that's just what new US presidents do. So you got easy fiscal, easy money in the US, and now you have easy fiscal and easy money in China. That's the big change of the past few weeks. So the basically both of the largest economies in the world are busy stepping on the gas. So you tell me, what do you think that leads to?
So when you look at the US, okay, so he cut by 50 basis points, or when I say he, I mean the Fed cut by
Jay
50
Powell. Yeah.
basis points. Do you think he's jumping the gun and he's always been fixated on inflation? And to your point, it's not really at the target rate of 2% yet. And do you think maybe he sees some other issues looming on the horizon?
Look, I the Fed, everybody says the Fed has two mandates, right? It's got a mandate on employment and it's got a mandate on inflation. The reality is the Fed has three mandates. The third mandate is making sure that the US government stays funded and that the US government is able to roll over its debt, and that there's no major bond market crisis. And of these three mandates, let's not kid ourselves, the third one is by far the most important. Keeping the government funded is the number one goal of any central bank, because if the government isn't funded, then me as a central banker, I'm not getting paid at the end of the month. It's it's pretty much that simple. So I think if you're a central banker, the keep the government funded is tends to be the number one priority. They don't say it openly, of course, but that is the number one priority. And no, look, I think what was happening in the US is the the US keeps issuing more and more debt and keeps having to issue it at a shorter and shorter time horizon, because in the past year, each time the U.S. government's tried, the U.S. Treasury has tried to go out and issue 10-year bonds, 30-year bonds. The market has said no, thank you, no interest. And so, if you think, okay, we got to keep this thing funded, we got to keep the show on the road. We don't want to create market hiccups before an election. We don't want to be held responsible for President Trump getting reelected. Um, then I think you cut. And to be honest, I think the Fed was bullied into that 50 basis point cut. Um, it was the market started saying, you started to see Wall Street Journal articles, oh, the Fed needs to cut 50. And then the sure enough, the market started to price in 50 basis points. And I think the Fed thought, well, if we don't deliver 50 basis points, we might have a sell-off in the market. And I don't want to be held responsible for a sell-off 6 weeks before the election. So here you go. Here's 50. Um, and so the economic conditions, meanwhile, you look at it and it's like, okay, sure, employment has rolled over some and sure, growth has rolled over some, but you know by and large, um things are sort of humming along. And in fact, if you look at things like the city economic surprise index, it's now back into positive territory. um, you know things things aren't roaring, but they're not bad per se. So look, I think the Fed did what it had to do politically. um, Cutting 50 basis point here was probably the least risky for themselves. And so they did that. And yeah, they'll probably do it again in November.
I was just going to ask you, there's still two more meetings to go. So you think they cut in November? What about December?
Yeah, I think they'll cut again in November. And they'll make a point about how data dependent they are. Um, and I think, they'll be, between now and November, there'll be quite a few uncertainties that will be resolved. The first uncertainty is whether the Chinese stimulus is for real and whether it, starts to pick up any traction. The second thing I think that will be resolved between now and November is, we'll have more visibility on the Middle East. If, between now and November, oil prices shoot up, or all the all the cyclicals shoot up on the back of the Chinese stimulus, then the Fed may feel little less compelled to ease monetary policy fairly aggressively. Um, I still think we get 50 basis point in November, but I'm also assuming we don't see $120 oil, which all of a sudden, is a possibility. That at least it shouldn't be the base anybody's base case, but it's a possibility that's suddenly on the table.
So you were talking about debt levels being 125% of GDP.
GDP.
And we've been talking about debt levels for decades now. And it's currently at $35 trillion. It wasn't too long ago when it was at half of that amount. And when you look at other countries like Japan, for example, I believe it's closer to 200%. Why can't they just keep kicking this can down the road? Why should we be concerned about this?
That's a great question. And to be honest, I'm not sure the debt to GDP ratio is the right number. Um, I always like to say that if I borrow $1 million from my dad, as a family, we don't have any debt. Um, and this is pretty much a good description of what's happened in Japan. You look at Japan, yes, they have 200% debt to GDP, to your point, but most of that debt is owed to themselves. 93% of Japanese debt is held by Japanese institutions, or Japanese private savers. Um, the ratio, when you look at the history of past debt crises, whether Greece, 10 years ago, 12 years ago, uh, Spain 12 years ago, Argentina 20 years ago, Thailand in 97, what you find is that it's actually not so much the overall level of debt, but what the percentage of debt held by foreigners is. Um, and that's the real problem. When one day foreigners can wake up and say, you know what, why do I own so much Greek debt? Uh, why do I own so much Argentina debt? Why do I own so much Thai debt? You know what, get me out of this. And if things start to go south, then all of a sudden you find that for about a third of your debt market, there is no buyer, because why would I have Greek debt in my portfolio, unless it gets cheap enough. And so, when you look at the US today, you could say, okay, how much of the debt is held by foreigners? We're approaching 30%, which historically 30% is precisely the level where things start to get dicey. Now, granted, I think if you look at the US, you might say the US, for the US, that rule doesn't apply, because even though it's like the animals in Animal House, George Orwell's, everybody's equal, but some are more equal than others. In terms of currencies, that's undeniably true. All currencies are equal, but the US dollar is definitely more equal than others. Um, and that it is the world's reserve currency. So while one day we can wake up and say, why the hell do I have Greek debt in my portfolio, you're less likely to say, why the hell do I have US dollar debt in my portfolio? Because here there's a simple answer. I have US dollar debt because I need to have US dollar debt to pay for my oil, to pay for my copper, to pay for the things that I need. So if you look at the countries today that have a high percentage of debt held by foreigners, there's really two that stand out. One is the US and the other is France, which happens to be my country. Now, I think, a French debt crisis today is, to me, much more likely than the US dollar debt crisis. And I'm not saying that having 30% of your debt held by foreigners is awesome. It does leave you more vulnerable. But I think in the US, because it is a reserve currency, again, it benefits from probably a little more cushioning and padding than other countries would.
And I'm curious, where is when you look at France and their level of debt, which is owned by foreigners, what's the
Yep.
percent?
Oh, it's also about 30%.
Oh, okay, good.
Yeah.
So let's look at the US markets now. The S&P just continues to roar higher. It's making new highs every other day, currently up over 20% on the year. What are your thoughts on the US market here? Do you think the S&P continues to climb higher into year end?
Um, I'm going to make like a Jesuit priest and answer your question with another question. And my question would be, where do you see the US dollar going? Because I think what's happened in recent years, US runs large current account deficits. It sends a lot of dollars abroad, sends a lot of dollars to China, to Japan, to Korea, to lots of places, to Canada. Um, and so people earn these dollars. And historically, what you would do is you would buy US treasuries with them. Um, and I think that's foreigners are no longer doing that. They're no longer doing that because they look at the US and they see that the US government is going to be issuing an additional 2 trillion in US treasuries, every year, for as far as the eye can see. And 2 trillion is bare minimum. If you get a recession, it'll be much more than that. And so all of a sudden it's like, I don't want to own that. So what do I do with these dollars? So one option is to buy gold. And I think you've seen a lot of that in China. You've seen a lot of that in a lot of emerging markets. But the other is frankly to buy U.S. tech stocks, to buy companies that are fairly unique, big global monopolies that you can't find anywhere else. You buy Microsoft, you buy Apple, you buy Google. Um, and so, when you look at the U.S. market, it has been very much driven by the Mag 7. And for me, the Mag 7 have really been almost receptacle for the world's excess US dollars. If you're a rich Chinese guy, you're earning dollars, you don't know what to do with them, you no longer want to buy Vancouver real estate, because they've raised taxes, because now there's homeless people in front of your building. Long list of reasons why you may not want to buy Vancouver real estate. And most of them having to do with the governance happening in Canada. Um, but so long list of reasons. And so you say, okay, what do I do with these dollars? Boom, let's buy Microsoft. And if I can change my mind tomorrow, it's such a big stock, it's liquid, etc. So you get a market that's very driven by a handful of names. And now, what's interesting today is as the US dollar looks like it's starting to roll over, what you're also seeing is the stock market is actually making new highs, but no longer with the Max 7 making new highs. And this is, I think, an important change from what we've experienced for the past 10 years or so. And every time the market was making new highs before, tech was the leader. Um, and so the Nasdaq was making new highs before the S&P 500, and the Dow was left far behind. And in the past few months, this has shifted. The Dow's now making new highs before the S&P and before the Nasdaq. Um, so, and I think this is a simple reflection of the fact that the US dollar is no longer going up. So, long-winded answer to your question, and I apologize, but I think the US dollar is done rising. And so I think the US equity markets are also done outperforming. I'm not a bear per se, because I think in this world of currency debasement that we live in, you're better off in equities than in bonds, and you're going to keep seeing money reallocated from bonds to equities. But I tend to believe that you're starting now to see other markets outperform the United States, and that this will be the trend for the coming years.
And so just to summarize what you said, you think the US markets, both the S&P and the Nasdaq are topping out. They're getting close to wherever they're going
Uh,
to go, and then they're going to start weakening as we go into 2025.
um, I no, I'm not sure. I think they're in relative terms they're going to underperform other markets, but I'm not sure they weaken. Look, you're having easy fiscal and easy monetary policy in the U.S. and easy fiscal and easy monetary policy in China, and you're having easier monetary policy in Europe. You're seeing a stronger yen in Japan, which is another reflationary force for the world. A stronger renminbi. You've got oil prices that are so far in check. Um, so as long as oil prices don't shoot up, again, that's a big caveat. I think the path is pretty well set for basically global reflationary trends and equity markets everywhere to do pretty well. Uh, I just think you're going to make a whole lot more money outside of the U.S. than in the U.S. So that's where that's where I've put my capital, to be honest. I think you're going to make more money in China. You're going to make more money in Brazil. You're going to make more money basically across all emerging markets. You're probably even going to make more money in Europe than in the US, or in Japan than in the US. But that doesn't mean that the US collapses per se, right? It just underperforms.
So let's look at China now. As you mentioned, the People's Bank of China recently cut interest rates. They also implemented a massive stimulus package. The CSI 300 index, the Shanghai index, both ripped and they're up 20%, give or take. What's your take on these policy changes and what do you think it means for global markets?
So I think the first point I'd make is, the general perception of everyone up until 2 minutes ago was that China was uninvestable, that it would be, it was just the worst place to deploy capital. The joke is that, up until 2 minutes ago, ABC stood for anything but China, and now suddenly it stands for All In by China. Um, and so you've seen this important shift. Now, the second point I'd make is that in my own career, where very often I've made the most money is when things go, excuse my French, from being really, really shitty, really, really terrible to plain average. If you go from something that's really horrible to average, there's a lot of money to be made in that move. As a lot of assets can revalue to to more normal valuations. And I think this is exactly what you're seeing in China today. So today, everybody looks at the package that and it seems that every day they're announcing new things. Very clearly, they're trying to crank up the market, um, and everybody looks at this and say, "Oh well, that's too little, too late. It's not enough," or this doesn't solve this problem, or it doesn't solve that problem. I mean, the Chinese economy is a massive economy. It's obviously the second biggest economy in the world. To think that the government could come with a magic wand and fix every single problem is, of course, delusional. But if you move from a list of 100 problems to a list of 50 problems, in that improvement alone, there's a lot of money to be made. So I look at China today, and what do I know? I know it's the most undervalued market in the world. You've got companies like JD.com, like Alibaba, that up until recently, more than half of their market cap was in cash at the bank. So these companies were trading on single digit price to cash flows. So dirt cheap, as foreigners decided, these stocks are, China's uninvestable. I don't want to be here. So it was a massive fire sale. So valuations are super cheap. Now all of a sudden you've got very strong positive momentum. And you have very strong policy support. It's very obvious that the government wants stock prices to go up. They've come out and said things like, we're encouraging corporates to, we're putting in new facilities for companies to lend for companies to borrow so they can buy back shares. Something that, in the past, buying back shares was a big no-no in China. The government didn't like it. So you put all these together and it's like, okay, so I got undervalued assets with strong momentum and policy support. Um, why should I avoid it? Like, this is pretty much, the trifecta. As an investor, this is exactly what you're looking for. Um, and I think a lot of people have recognized this and said, look, this reminds me of 2008, 2009, when governments, threw the kitchen sink at the economy to get it out of its rut. Um, or even closer to home, 2020 during the COVID period, when you had twin fiscal and monetary policy easings. So this is where we are in China, where um, that's where we are. And I think most people are still trying to fade this. Most people are still, everybody I talk to tells me, oh well, it's the response to the Chinese stimulus is one of two things. It's, oh, this is too little, too late. Uh, Option one, or option two, people say uh, the economy must really be in trouble for them to kitchen sink it like they're doing. So this isn't good. Um, and all this tells me is that people aren't positioned for it. They're trying to justify in their own mind why they don't own Chinese stocks that are undervalued, have strong positive momentum, and have policy support. You know, Sometimes in finance things are not that complicated. For me, this happens to be one of them. When you've got cheap assets that are going up and the government wants them to go up, it's like, jump on board. This is going to be a fun ride.
And I understand what the naysayers are saying because when I look at it, when I first saw this news, I thought, wow, things are really positive, or this is really positive for the Chinese economy and the global economy. But then you think, whoa, when you stand back and you think about it, like you think maybe things are really, really bad in China. Maybe the central bank sees things happening on the horizon that you and I will not see, no different than what the Fed sees in the US. Maybe because of the high interest rates, they see further regional banks collapsing, and that's why they slashed interest rates 50 basis points, and they're just trying to get ahead of it, but maybe it's too little too late. Could this also be the problem in China? And the reason why I ask this is because I recently read an article, I don't recall where it came from, but it said 34 of China's top 50 property developers have defaulted on their debts in 2024. So do you think the central bank could probably see some massive problems down the road?
So this is a super important question, and it goes to the very heart, I think, of people's philosophies. And you know, d- do you think government officials know better than the market? Uh, and I mean, this is an important question. Some people believe yes, some people believe no. Everything in my own personal experience tells me that government officials do not know better than the markets. You may remember I think you and I are roughly the same age. You may remember in 2007, Ben Bernanke, testifying to Congress that don't worry about the subprime; it's well controlled, and it's really nothing to worry about. You may remember just as recently as October 5th. Jake Sullivan publishing an article in the Foreign Affairs magazine, Foreign Affairs Review, saying that the Middle East had never been as peaceful as it was today on October 5th of last year. So the idea that, oh, government officials are smarter than the you know the combined brains of the markets, to me, is belied by, frankly, my 30 years of experience in the markets. Um, and this isn't to rip on any central bank, either the PBOC or the Fed. But obviously, if central bankers are so smart, how do we get into this predicament in the first place? So I would say, again, I'll come back to the idea that where you make the most money is when the market moves from being really, really shitty to just plain shitty, or to even just decent. Um, and so, to your point on China, the fact that all these property developers have gone bust, the fact that there's been a lot of pain in the real estate sector, that's well covered territory. This has been unfolding for 5 years. China's been stuck in this balance sheet recession for 5 years. This is, in essence, what's triggered this shift of policy that we see today. Uh, and one of my favorite sayings that was taught early on is, if it's in the press, it's in the price. If you read this article, that was in the price. What wasn't yet in the price was the government's reaction. Um, and and now that the government's reaction is here, the price have had to adjust very, very rapidly, because everybody, when it came to China, everybody was on the same side of the boat. Everybody was on the side of the boat. Oh my God, real estate is going down. This is a balance sheet recession. This is going to be like Japan in the 1990s, so on and so forth. And all of a sudden, just the possibility that, hold on, there is another path possible. And no, all of China's problems aren't going to be solved with a magic wand. But if all of a sudden it is no longer the Japan scenario, there's a lot of assets that basically are mispriced and that offer tremendous value.
Oh, and you forgot the most famous line of all from Jay Powell in Q4 of 2021, that inflation is transitory.
Yeah, of course. I mean, you're absolutely right. The list of examples, or frankly, um, we could look at our own, Canada's central banker. What was it? Also in late 2021, um, telling people, go out and buy houses because we're not raising interest rates for a very long time. Um, I think Tiffany said that at the in uh, in late 21, didn't he? You'll know better. You're the one based in Toronto, but um, I think that the Canadian central banker had a pretty good doozy as well, encouraging people to gear up for real estate pretty much right at the top.
Yeah, yeah. So I'm going to digress for a minute, okay? And there's an index, you might be familiar with it. It's called the Construction Crane Index. It just
Yes.
measures the number of construction cranes throughout major cities in North America. Believe it or not, Toronto has the highest number. I believe it's 220 cranes. The second
Wow.
highest city in North America is LA with 50. So that
Wow.
gives you some
Still
idea.
today? Still today? I thought
It
real
might be
estate.
it might be lower now. It might be approaching. I believe that was a Q2 number, so maybe it's approaching 200. It's still a big number, and as you know, when you build a skyscraper, when you build a condo, it
Yeah,
takes many years to
for sure.
complete the project, right? So you just can't shut it down. But it's going to be interesting to see what these higher interest rates do to this whole condo market in Toronto in the coming months.
I thought it was already softening. Is it not already
Oh,
softening?
no, it's softening, right?
Okay.
It's
Yeah.
softening for sure. But and this is one of the issues. You get a lot of individuals who have invested in the Toronto real estate market.
Yeah.
Maybe they own two, three, four condos. They always buy them pre-built, right?
Yeah.
And then maybe they pay, let's just throw simple numbers, $1 million for a condo. But by the time it's completed and they go to sell it or rent it out, maybe it's worth 750. Right. So they're already in the whole 250. And of course, now you got to go refinance. The interest rates have gone up and the whole thing just, it's downward spiral. Anyhow, it's going to be very interesting to see how things shake out here in the Canadian real estate market.
So who ends up with the losses? Is it the banks? Because in Canada, you can't really walk away from things like in the U.S., right? And in the U.S. in 2008, people mailed the keys back to the bank. Yeah, people were taking 100% loans, 100% LTVs, and when things went down, it's like, oh, boom, ship the keys to the bank, not my problem. But in Canada, you don't really have that option, right? People are personally liable. Is it like China? Because in China, you buy a house on same story, you buy it on plans, etc. You don't really have the option of walking away. If you walk away, you can get personally sued for the commitment that you took.
Well, maybe you can get sued, but if you declare personal bankruptcy, what's it matter? You walk away. And then who's
Yeah.
left holding the bag? Then the condo developer goes under, then the banks take a big hit on their loan portfolios. Like
Yeah.
I think there's a real problem pending here in
So,
Canada
so you
specifically.
think you think it'll be the banks who end up being the bag holders?
Oh, ultimately, yeah. Yeah.
Yes, that makes
But
sense.
let's get back on track here. I want to look at the US and I want to look at China together. Both of these economies represent 45% of the global economy. So, what happens in these two countries impacts the rest of the world, including Canada. And so, in the US, as you mentioned, they got massive fiscal spending. Now they have expansionary monetary policy, both of which are bullish for the economy and also the markets. We have the same thing happening now in China. So, what does this mean for the rest of the world?
Look, that's a super important question because historically, when China would stimulate, you didn't have to think twice about it. It's like, okay, China's stimulating. Uh, their typical tool through which they stimulated was real estate, infrastructure spending, construction. So when China would stimulate, you went out and you bought BHP, you bought Rio Tinto, and you bought LVMH. Now, what's fascinating, if you look at the past few weeks, is China's stimulating once again, and equities are rallying hard. But you look at your BHPs, your Rios, your Freeport McMoran, um, your typical commodity plays. And they've rebounded a little bit, but they'd had a horrible 5 months. They were beaten up. All the cyclicals had gotten crushed. They've rebounded some, but it's actually been pretty disappointing given the Chinese stimulus. So, frankly, same story with LVMH. I think it's bounced back like 6 or 7% from the lows, which is nice. But when you see Chinese stocks going up 30, you might have expected more. And I think this reflects a reality is that this stimulus is going to be different from the past ones. Past stimulus, again, were all about real estate, all about infrastructure spending, all about boosting construction. And this isn't what China's doing now. It's not what China's doing now, partly because, you know, the need to create construction jobs is no longer there. 20 years ago, when the economy slowed down, you were worried that the 20 million guys leaving the farms every year for the cities wouldn't get jobs. Because when you were leaving the farm, there was one of two jobs. Either you worked construction or you worked in a factory. Um, the Chinese economy has evolved dramatically since then. The challenge for the government is no longer creating 20 million construction jobs a year. The challenge for the government now is you got 10 million kids leaving universities who want service industry jobs. And so now what you're seeing is a boost. They're sending checks to poor people. They're trying to create to boost consumption, and of course, wealth effect through the stock market is one way you can boost consumption at a fairly cheap cost to the government, and so that's what's being organized. Um, but so in the past, the way you played reflation, the way you play a Chinese boom, again, you go out, you buy iron ore, or you buy copper, and you buy nickel, or whatever else. But I think this time it's not going to work. This time you have to go out, you got to buy the Macau casinos. I think you got to buy the Chinese education stocks. I think you have to buy, uh, different things than you buy the Chinese internet platforms. You buy different things that you would have bought in the past.
And so when you look at both of these countries engaging in very aggressive monetary and fiscal policies, so you already said you're very bullish on China and these changes that we've seen. You're bullish on the U.S., not as much as China. So what are you recommending to investors? How do they position themselves in the coming
So
months?
so my starting point, our process as a firm is we like to start off saying, look, asset prices are driven by the interaction between economic activity and inflation. And that gives you, so you put economic growth on the on the y-axis, and inflation on the x-axis. And that leaves you with four possible scenarios: an inflationary bust, an inflationary boom, a deflationary boom, or a deflationary bust. Now, a few months ago, a couple months ago, everybody was pricing in a deflationary bust. You started to see utilities rally, staples, healthcare, bonds, and everybody was pricing in the deflationary bust for a pretty simple reason. It looked like U.S. growth was slowing down. China was caught in this horrible balance sheet recession, etc. Fast forward to today, and all of a sudden, it seems like everything is back to pointing to an inflationary boom. Easy fiscal policy everywhere, easy monetary policy, strong yen, all the reflationary forces that we've already talked about. So, if we're in an inflationary boom, historically, there's many ways you play it. You can play it by buying emerging market stocks. You can play it by buying metals. You can play it by buying precious metals. Those are like the main three key asset classes that you buy to play an inflationary boom. Against that, so this is what I've been buying today: metals, precious metals, emerging market stocks, including China. The risk, I think, today to my inflationary boom scenario, you always have to look over your shoulder when you're an investor. You might have a right scenario, might be in sync with the market, and you have to think, okay, what's gonna derail me here? For me, the big risk is that oil prices spike, and I worry about this. Obviously, because of what's happening in the Middle East, obviously because what's happening between Russia and Ukraine, but also because when I look at the market positioning today on energy, it's about as extreme as I've ever seen it. You've got record short position on energy out there. So that seems to me an anomaly given where we are with with the Middle East. It's like, who goes out and says, oh, Israel's about to bomb Iran, let me short oil. But apparently people are doing it. And I look at the amount of storage today in the United States. Cushing storage is close to record lows, and the Strategic Petroleum Reserve is close to record lows. So I think we've had very soft prices over the past 6 months on energy, as basically the U.S. drained all of its inventories, and the I think Iran also drained all of its inventories because it probably wanted to sell everything it could before a potential Trump takeover of the White House, because they know that if Trump wins, their oil won't be able to make it to market anymore. So might as well sell whatever you can as quickly as you can. So, I think right now we're in this awkward situation where geopolitical tensions are sky high, and storage of oil everywhere around the world, except perhaps China, is close to record lows. So, putting it all together, I do want to play the inflationary boom, and I worry about the inflationary bust that a spike in oil could trigger. So I also have a fair amount of energy names in my portfolio.
So I'm glad you brought up this risk of inflation. So let's just say in Q1 or Q2, oil is through $100 again for whatever reason, and maybe prices overall just start lifting. Do you think there's a threat or maybe another risk that instead of cutting rates come Q1 or Q2, the Fed is increasing rates?
So look, I've been an inflationista for a long time, just to put cards on the table. And so first things first, oil is back above $100. It's not maybe we'll get inflation. If oil's back above $100, we are getting inflation, and that'll be that. Now, will the Fed hike interest rates? I'm not sure, actually. I think they may. I think the Fed could easily say, well, it's linked to oil. It's not true inflation, etc. My take on the Fed, if you remember pre 2022, 2023, the Fed was actually talking about wanting higher inflation. They were saying, oh, we need higher inflation over the course of a cycle. They wanted it. When you see the growth in monetary aggregates that we've had, you got to think the Fed hires 800 economic PhDs. Some of these 800 economic PhDs must have taken Econ 101 and know that if you're running, M1 growth at 23% year on year, while budget deficits are running at 7% of GDP, you're going to end up with inflation. I'm gonna guess that they did go through that class, at least some of the 800 PhDs. So the inflation was a choice, and it's a choice that was made because that's how you deal with having debt to GDP of 125%. It, that's how you get it back. You get back you get the debt back down. Um, so the inflation was a political choice. They didn't want inflation at 9, but I think they want inflation at 4 or 5% a year, while bond yield 3.5, 4, and that allows you over time to take care of the debt. You slowly default on the debt, not through a big shock, but through the atrophy that comes from inflation. This is again a political choice that was made a while back. So I don't think if inflation reaccelerates, I think the Fed will again, just as it did last time, drag its heels in getting in front of it.
And Louis, quite often when you look at a black swan event, it's something that nobody saw coming. Okay. And when I think back to the 0809 financial crisis, in '07, there was a couple of hedge funds that were focused on subprime. And I believe they were owned by Bear Stearns, and
That's right.
they went under. And nobody
Yep.
thought much of it because they were these two little hedge funds that nobody's ever heard of.
Yep.
But that was really the beginning. And then as we went into 2008, things kept getting progressively worse. Do you see anything like that happening? Maybe it's commercial real estate, maybe it's private equity.
Um, that's a good question. Um, Look, I think again, right now you're getting easier fiscal, easier monetary policy, and these are powerful forces. They're a big tailwind for markets. Now, to your point, some things have gone bankrupt. We had Silicon Valley Bank last year. We've had all the problems with commercial real estate in the U.S. Um, I do think that private equity as an asset class is going to fail to deliver the 15% that's been promised. I mean, here the maths, I think, speak for themselves. If you go back 25 years ago, you had roughly $500 billion in private assets in the US, or private equity, venture cap, uh, infrastructure, commercial real estate in general. Funds in that space account for roughly $500 billion. Today, funds in that space account for $15 trillion, 1.5 trillion with a T. That's more than 50% of US GDP. So it's one thing to promise people 15% returns when you're less than 5% of GDP, but when you're more than 50% of GDP, and GDP is growing at 5-6% nominal, that's a hell of a, to promise 3 times the nominal returns of GDP. That's a big hurdle. That's a big ask. I'm not saying that some won't do it. Some will definitely do it. But can 15 trillion do it? The maths don't work. It's just that simple. So, yeah, but does that mean it's a disaster? What if private equity from here, instead of delivering 15% returns, delivers, let's say, 2% returns, which is worse than inflation and worse than what you could have done on cash. And so it's disappointing, but it's also not a disaster, right? It's not like it doesn't collapse the system per se. The reality is, collapses in the system, for the system to really melt down, typically as we saw in 2008 or as we saw in 2011 in Europe, you need the banks to start hitting the wall. I think we had a bit of an inclination of that with Silicon Valley Bank, but you look at, I look a lot at the banks, not always to invest in them, but just to, as a sort of indicator, sort of health check. It's sort of the pulse of your economy, and bank shares have been performing pretty well this year. So bank shares are telling you, yeah, things are humming along. We're making money. We've cut back our costs. Barriers to entries have risen with all the increase in regulations. So we're making money. I mean, we were discussing the problems in Canada just now, but if I'm not mistaken, the share price of Royal Bank of Canada is close to all-time highs. It might be at all-time highs, and in spite of all these problems in real estate that are well known. So, yeah, I don't know. This isn't to say you can't have a crisis, but for me, when I think of the potential catalyst for a crisis, I come back to a spike in oil prices. And to be very clear, I'm not saying we're going to see a spike in oil prices. I'm saying if we do get a spike in oil prices, that's how the system starts to spin its wheels. And by the way, that's what happened in 2008. Oil prices moved from $80 to $150 over 3 months. And in so doing, it basically broke the back of an over-levered U.S. consumer. And from there, the rest is history.
So when we look out into 2025, overall, it sounds like you're quite positive.
Yeah, I mean, again, I'm not super positive on U.S. equities. Again, they're like quite richly valued, but elsewhere around the world, I find stocks that are, very attractively valued, very often with strong policy support, you know, low oil price. It's like it's kind of what the doctor ordered, frankly. It's, when you're an investor, you're like, okay, when central banks are easing and easy fiscal policy and low oil price, and companies are funding themselves at very cheap levels with corporate spread close to record lows. It's like, yeah, I mean, I think there's enough there to be decently optimistic about the future.
Well, Louis, that was a fascinating discussion. I want to thank you very much for spending time with us today. If somebody would like to follow you online or learn more about your thoughts, where can they go?
So I am on Twitter. My handle is Gave Vincent, which is my middle name. But I don't post all that often. We GAFCAL, we're a bit of a hybrid group. We do different things. We have an asset management arm. We manage money for institutional investors in Asia. We publish research for institutional investors in Asia as well. But then we have a private wealth arm in the US called Evergreen GAFCAL. And we publish some reports there as well. So if you're an institution, please contact us through our website, gafcal.com. If you're an individual, best place to contact us is evergreengafcal.com. Well, yeah, you can look at either of these websites.
One more question before I let you go, Louis. You've been living in Hong Kong for many years now. What's your favorite thing about living in that part of the world?
Oh, there's so many. First, I love how safe the city is. You never have to look over your shoulder. It's just something we take for granted in Asia, and then we come back to Europe or North America, and the cities feel a lot less safe than they did 20 years ago. But what I really love about Hong Kong, look, it's a city a little bit like Vancouver. It's mountains that fall into the sea. You've got, obviously, we don't have the snow, but we've got great hiking. We have beautiful beaches. It's a city. There's always things going on the weekends, in the outdoors. So it's most people imagine Hong Kong as this big concrete jungle, but from my office I can hop in a cab and within 20 minutes I'm hiking where there's monkeys and snakes, and you're in the middle of the jungle.
Yeah, it's a city I definitely want to go to at some point. Well, listen, thank you very much for spending time with us. I do appreciate it.
Pleasure. Have a great day.